Okay, good afternoon. We are moving to the final session of this conference, which is about the endless issue of Eurozone reform. As I mentioned yesterday, Mario Centeno had to cancel his participation, unfortunately, because of a private issue that had come up. So we had to rearrange this a little bit, and our suggestion is we will just do all the presentations. So I will start with my presentation. Then we will have Anne-Laure Delatte from CEPI in France, Marek Mora from the Czech Central Bank, and Markus Brunnermeier from the University of Princeton, who has just arrived. His plane was late, but with some help from above, I guess, he arrived 2 minutes before the start of this session. So we are all here, and we are ready to go. Good. Now, of course, the idea of this presentation was that I would introduce the presentation of Mario, who was supposed to talk to us about, the state of Eurozone reform, the letter you might have read about, the letter he has written to the heads of government. So I'll, try to put some of that into my own presentation. So the title of my presentation was Eurozone Reform, What is Missing? As you know, these two had the plan to come up with, some grand scheme about Eurozone reform. There were a lot of, the expectations, I guess, were very high. The plan was to, devise some sort of great plan, have an agreement in Meseberg, and then at the EU summit last week, have this stamped off, this French-German initiative stamped off by everyone else. That was the plan, I suppose, last year in autumn, maybe. It didn't quite work out like that, but still, there was a Meseberg agreement, and there was also a summit and a summit declaration. Now, I guess the result of the summit shows that this is a very difficult subject, and I like this cartoon. I think it makes clear how difficult it is. Here you see Jesus. Jesus has no problem defying economics by multiplying fish and bread. But he says, don't ask me to solve the Eurozone reform, okay? I think that makes pretty clear how difficult it is. Don't ask me to solve the Eurozone crisis. Now, what would I like to say? Here is what I have to say in a nutshell. 6 points. One, as we all know, the Eurozone benefits from a cyclical recovery, which is strong, and this is very nice. We have a recovery in Europe. But the Eurozone remains highly vulnerable to the next downturn. Why? Because monetary policy hasn't moved away from the zero interest rate environment, so there is little to do at the next downturn. Second point, if nothing happens, the next crisis will be more costly than necessary, and the Eurozone will drift towards more economic divergence, hidden and reluctant bailouts, and growing political conflicts if there is no reform. So it is not like the Eurozone is in a great state if we do nothing. It is necessary to do something about this, because if we do nothing, which is not totally unlikely, or almost nothing, this is what's going to happen. So it's not a good scenario. Number 3, reform needs a balance of more market discipline and more risk sharing. We need both. I know many of you know the paper published by this group of French and German economists, 14 French, so 7 French and 7 German economists working in different countries, but with these nationalities. We have written a joint paper. I was part of this group, and we have written a joint paper, and the theme, the title of the paper is, yes, we need risk sharing, more risk sharing than we have today in Europe, but we also need more market discipline. We need both. There is not going to be a reform of the Eurozone there is not going to be one, and certainly not going to be one which is successful, which concentrates only on risk sharing or only on more market discipline. We need both. That's the idea, and I will try to defend this idea in a minute and tell you what this means in practice. Number 4, the June EU summit has failed to address the most important issue, And the most important single issue in Eurozone reform is that banks hold too many government bonds of their own countries. This is the most important problem in the Eurozone. If we solve that problem, we have a chance of solving the others. If we don't, we won't. I'm firmly convinced by that. This is the single most important issue. And now saying that the EU June summit has failed to solve this problem doesn't mean the summit is a total failure. I mean, in the current political climate, the summit has agreed on something. I think this is a positive sign. It's not bad, right? But it has failed to address the most important issue, and that is a challenge. Number 5, I think that one is very important also. A lack of trust in reliability of European rules and agreements is a key obstacle to reform. It's not that we cannot come up with technical solutions and ideas about all kinds of things. One of the main obstacles to successful reform is that there is very little trust by citizens, policymakers, and many people in the reliability of rules we write down. And I will come up with an example trying to demonstrate that, why this is a big problem. And 6th and last point, how can this be overcome? I think that you cannot order people to trust in something. That's impossible. But trust grows, and trust can be built by successful cooperation in other areas. So in areas where less initial investment is necessary. You have a trust problem. If you need to invest, you need to move first, put some money or something on the table, which is important to you, and you need to trust the other side that it won't cheat on you, destroy it, and so on. This is, the economic meaning of trust. And if trust isn't there, we need to engage in other projects that require less trust, so less initial investment from one side to be, and if these projects are successful, if they work, and we've, during the last 2 days, we've discussed some of these projects. They are there. We just need to do it. I think we need to do more things together, because if we have more projects together in Europe, trust will grow. And it is also less attractive to defect, to be non-cooperative in certain areas, because you have other areas where you are interested in maintaining cooperation. So we need to see Eurozone reform in the context of other European reforms and other joint projects we undertake. So let me explain these 6 points. The outline of my talk is following. I would like to talk a little bit about the current economic situation in the Eurozone. We need to see it as it is, not as we would like it to be. Then what will happen if we do nothing? I think that, thinking about what will happen if we do nothing is very important, because in particular in Germany, we have this view that, people tend to reject a lot of reform ideas, thinking that everything will be fine if they reject them. If that was the case, that would be nice, but the trouble is, if nothing happens, we are facing a very negative scenario, and we need to understand that. In particular, we are facing a scenario with massive bailouts and massive costs for Germany in the next crisis. And that's why I think, defending the status quo and saying, we don't want risk sharing is not a very smart strategy, because you need to think about the consequences of leaving the status quo as it is. Of course, there is always some element of speculation in that, but I hope I can convince you that this scenario is not very benign. What should we do if the status quo doesn't work? I would like to talk a little bit about our reform proposal, the French-German proposal. I still think this is at least the general idea behind this is the only way to move forward. It's the only hope to move forward on Eurozone reform, and also the right way to move forward. Okay, so what's the current economic situation? As I said, we have a recovery. What you see here in this graph is the so-called output gap. And if the output gap is negative, it means you have unused capacity, so you're in some kind of crisis. If the output gap is 0, capacities are fully used, and you are in a neutral point of the cycle, if you like. And if the output gap is positive, you are working above normal capacity. Of course, we should be aware that output gaps don't exist. They are invented, or they exist, but only in the minds of academics and scientists and bureaucrats and technocrats. So output gaps are based on theory, and they are calculated. And we argue now they are zero. Now, there is, unfortunately, a strong tendency for people to say the output gap is low, to underestimate the output gap. Because if you underestimate the output gap, if you say, look, the output gap is, let's say, -2, what you're saying is the normal state of the economy is much better, and we will return to it. You are saying, you can engage in expansionary fiscal policy because the future is much better. We just have to get there. We have to close the output gap. And there is evidence, for instance, that the Italian output gap, just to name one country, is systematically, the estimates are systematically wrong. They are biased. Okay? It's been systematically overestimated, so the gap has been overestimated. The number is too low. And that's one of the difficulties. But let's assume these estimates are more or less reasonable. So we would say, okay, in the economic cycle, we have an upturn here, and that's nice and very positive. And here, unemployment rates have been very high in the crisis, in particular in Greece and in Spain, and they have come down significantly, as you see here. In these two worst affected countries, of course, Germany is an exception, has a very positive labor market performance. But generally, it's not so bad. So if you look at that, you would say, okay, the glass is half full. It's not half empty. Things are improving. There's not just bad news. There is good news at this cyclical level. The crisis countries are recovering, at least for the time being. Yeah, here's another piece of very bad news. As you know, some of the member states have very high levels of public debt, and they have no fiscal space in the next crisis. Italy has 130% debt to GDP ratio, Portugal the same, France and Spain at 100%. They have no or very little fiscal space when the next crisis comes. So it is urgent to bring down these debt levels. And you should use the current situation for that, because it's pretty clear if we start the next crisis with these debt levels, we will end something close to Greek levels. And of course, we can go the way Japan went, but we won't make it to the 200% debt to GDP ratio because we are not Japan. Okay. We are something else. So, there is very little fiscal room. That's bad news. Then we have this issue of non-performing loans. These numbers are coming down. So we have some countries where they're still high. Greece is a special case, but then Portugal, Italy, but they have come down. The trouble with non-performing loans is that banks can decide, basically, on their non-performing loans, basically by lending to companies in difficulty. They can just lend more. Of course, you need the capital to do that, but to some extent, non-performing loans are, can be chosen by banks and also by supervisors. I think these numbers should be seen with, I suppose critically, but still they have come down. So here the news is also not so bad, I would say. The direction is fine. They have been reduced. Of course, you see the asymmetries. There are still some asymmetries, but these non-performing loans are coming down as they should in an upturn. Then here, the biggest issue, as I said, ownership share of domestic banks in sovereign debt outstanding. And at the top here, you see Italy and Germany. Not just Italy, it's also German banks owning a very large part of domestic government bonds. And why do I say that this is the biggest issue? If we have the idea that this Eurozone is a place where member states are responsible for their debt, it follows that this debt needs to be restructured if there is a crisis. And if you want to restructure the debt, you don't want to have a banking crisis. If you have banks full of domestic government bonds, and you want to restructure the debt, you have a banking crisis. And nobody wants a banking crisis because it has a huge impact on the real economy. And that's why in this situation, the no bailout clause is not credible. simply not credible. Financial market investors know this, and you get no market discipline. So this situation is one where you get a guaranteed bailout because you don't want to have a banking crisis. It's inevitable, and it is exactly why we had the bailout in the last crisis. Of course, some people say, well, why don't we save the bank? Well, we won't. First of all, because it's complicated, and secondly, because it's extremely unpopular. It's much easier for governments to say, we are saving a country, we are saving Greece or whoever it is with credit. So, this Eurozone reform, the idea that the no bailout clause will be more credible is going nowhere. Nowhere unless we solve this problem. It's going nowhere. It makes no sense to discuss. I mean, in Germany, we discuss a lot about rules. Let's return. I have to say, I cannot hear it anymore. Let us return to the rules. It doesn't make the slightest bit of sense as long as we have this situation, because the rules are not credible. The rules were, no bailout. The creditors will pay. Well, this will not happen. Okay, that's why this is the key problem we are facing. Okay, bringing down this part. Yeah, here are the rules. Something else we need to understand is that fiscal rules, as they are today, the 3% rule, is not credible either. So it's just not respected. Here you see the rule violations since the start of the Eurozone across countries, and you see here we are all sinners. There is some asymmetry in sinning. So those who are sinning least are Sweden, Luxembourg, and Estonia. Then we get, some Scandinavian countries, Bulgaria, and the big sinners. Germany is a medium sinner, 7 violations of the 3% rule, and the big sinners are Greece with violations of the 3% rule in virtually every year of membership, and then other violations. Okay, so we need to understand that fiscal rules like the 3% rules are, I think, useful as an orientation, but they cannot be enforced. We have sovereign countries. We are a currency union of sovereign countries. And if they think it is against their national interest to respect the fiscal rules, they will violate them. By the way, the fiscal rules in the contracts about the Eurozone didn't say you can have 3%. The Stability and Growth Pact was very clear. It said 0%, a balanced budget. That was the rule. And the idea was, to leave room for anti-cyclical policies, you can go up to 3. So in a bad crisis, you can go up to 3. And what the political process made out of it was, 3% is fine. And if you have more, don't worry. You can always say, the situation is so bad, we need to do something about it. Okay, but, some people say we just need to write down rules and then we can engage in risk sharing, introduce Eurobonds, for instance. It doesn't work. You may remember that in 2012, when the ESM was introduced, so some form of risk sharing. Part of the deal was introducing the fiscal compact. It's another set of fiscal rules saying you should have a balanced budget. You should introduce rules into your own constitution saying Schuldenbremse, schwarze Null, the balance needs to be budget. The budget needs to be balanced. You can have a deficit, structural deficit of 0.5, not more. And maybe you remember this unfortunate word by Volker Kauder, Europe. He really said that. Europe speaks German now. Not a very smart thing. I don't think he's repeating this now, because nobody is respecting this rule either. Okay, it's something we need to understand. So there is overconfidence in Germany in things we write down. These rules. Okay, and as I said, as I just showed you, if we look at Germany in the early 2000s, we didn't respect the rules either. So it's not like some countries are the big sinners and Germany respects it. When it's against the German interest, Germany will violate the fiscal rules in the future. I don't have the slightest bit of doubt about that. We need to understand that. I'm not saying, don't get me wrong, I'm not saying fiscal rules are not useful. I think they are. Because at least you have a public discussion, it's an orientation, where should we be? But we shouldn't confound this with reliable things where you can go to court and really enforce it. And it can never be the basis of debt mutualization, never. It's not strong enough. Never. We should never make that error. Some people, I hear this, in particular in Germany, if we agree on fiscal rules, we can have debt mutualization, because debt mutualization is not something where you can say, oh, sorry, I didn't mean it. Okay, if you underwrite it, it's there. You cannot enforce these rules, okay? It's more like you have a neighbor who is in financial difficulties, and you say you help him, and he will, you make a contract with him, and he will say, I'll try to get a better job and I'll try to work. You would never underwrite all his debt on the basis of this contract, right? On the basis of you don't do that. In particular, not if you want to remain friends. I think that's very important. So fiscal rules are useful, but they are not totally reliable. Then we have the Italian situation. So we have a party in Italy that openly defies fiscal rules. They've said, we reject this. We want different rules. We discussed yesterday that, I think it's fair to discuss the existing rules and maybe put something else on the table. But the danger clearly is that, the coalition contract in Italy will be implemented, and then we have, strong deviations from the fiscal rules. And all of that makes Eurozone reform more difficult. If we think about Eurozone reform, how do we address situations where we have individual countries, it could be other countries, rejecting these rules, with governments that have explicitly said, we reject these rules, we don't like them. It's an unusual situation. And the tensions, in this entire construction, despite the recovery, can be seen in the target balances, emphasized by Hans-Werner Sinn for a long time. They are currently at record levels. They were at very high levels. These numbers. They were at very high levels. In the crisis, in the early, let's say, Eurozone crisis, then they went down after the whatever it takes speech, and now they are going up again. The European Central Bank, the Bundesbank say, don't worry, it's just a technical effect. You should always get very critical when people say it's just a technical effect. It's true, it's related to QE. Foreign investors sell, let's say, Spanish government bonds or Italian government bonds. They are bought by the Spanish or Italian central bank. And the idea is they will take the money and invest it in the Italian economy by, give credit to a company. Investors don't do that. They put the money on an account at the Bundesbank because they have no confidence in Italian or Spanish assets. Some people say this is not capital flight, correct? The capital just, never comes back, if you like. So why does the foreign investor buy Italian government bonds? Because Mario Draghi has said you will get your money back over the OMT problem. But Mario Draghi hasn't said you get your money back if you buy corporate bonds in Italy. That's why people don't buy corporate bonds. So this is clearly a sign of lack of trust. It's not a merely technical thing. It's a sign of lack of confidence in the periphery. And it's very serious because, as we all know, in the case of exit, that would be an issue. How can a country that leaves the Eurozone, especially if it devaluates, pay back the target balances? It's very difficult. And some people say this will never happen. But even if it doesn't happen in equilibrium, it certainly makes the negotiation, the bargaining position of these countries stronger relative to the core of the Eurozone. Okay, so the fact, if someone can ruin you, this is relevant even if he doesn't do it in the end, because you do what he wants. Okay? And here it's the same. Okay, it's a very serious issue. And we need to do something about it. Okay, now what has been decided at the June EU summit? First of all, there is, this is a one-page declaration on the Eurozone. Maybe you've seen it. There is, first of all, a reference to the Meseberg Declaration, saying in line with the leaders' agenda and the outcome and so on, including the one presented by France and Germany. The Euro summit today agreed on the following. So there's a reference there, but no endorsement because, for instance, there was no agreement on the Euro budget. The key decision is that the ESM will provide a fiscal backstop to the Bank Resolution Fund, to the European Bank Resolution Fund. It's a fund for bank resolution. And the idea is that in European Banking Union, if a bank gets into difficulties, the following will happen. There will be 8% bail-inable capital, 8% of the balance sheet. Bail-inable capital, so capital that, where the investors will lose their money first to absorb possible losses. Then the second line of defense is the Bank Resolution Fund. It's not very big, but it's there. And then when this money has been used, there would be the fiscal backstop. Some more details, but that's the that's the general idea. And here the idea is the ESM will provide credit to the Single Resolution Fund, and this will be collected afterwards through contributions by banks to this fund. Okay, that's sort of the key decision. And taken in isolation, I think this decision is fine. Although when you have a banking crisis, you may need much more money. But taken in isolation, this is fine. But as I said earlier, I think we need a balance between these risk-sharing mechanisms and market discipline mechanisms. And there is nothing moving towards market discipline. There is a reference in the Meseberg Declaration to government debt restructuring. But as I said in the beginning, government debt restructuring is not credible as long as we have the situation in the banks, with them holding all these government bonds, and that's why this reference to government debt restructuring in the Meseberg Declaration, which is important, is not enough. Because if you write down something that's not credible, it's not worth a lot. Okay, that's where we are. And then, there's some talk about, starting a roadmap for beginning political negotiations on the European Deposit Insurance Scheme. There's a reference to a letter by the Eurogroup president. And if Mario had been here, he could have explained to you that this letter is very interesting. If you read it, it says, there is one point where we really have no agreement at all. And that's sovereign exposures of banks. So the most, banks holding government bonds, this is where disagreement is the strongest. And as I said, this is the most, I think this is the one most important issue in Eurozone reform. And here, disagreement among the member states is strongest. Okay, so here you see what the challenge is we have before us. Okay, so, that's a summary, but maybe let's move on for time reason. The economic situation has some bright spots, recovery. There is at least some agreement at the last summit. I think that's a positive sign, but there are key elements missing, really. Now, what will happen if we do nothing? So a lot of people, in particular in our country here, but also in some other countries say, it's all nonsense. The member states should get their house in order, and we do nothing. We leave things as they are. They should respect the contracts, and they should get their house in order. Now, the difficulty is, as we've seen, we have weak economic and fiscal governance in the Eurozone, so rules will not be respected. We have fragility. There is this nexus between national governments and their banks. This will, one of the disadvantages of this nexus, next to the fact that you can't restructure government debt, is that if there is a crisis, this nexus makes the crisis stronger, will make the crisis more costly. Because, if a country gets into financial difficulties, government bond values may fall. This will hit the banks because they have these bonds, and the banks get weaker. Now, the banks may want help from their national governments, and so you have this doom loop making the crisis more costly. Of course, with European Banking Union, you could say maybe it's not so costly. But how credible these things are is a question. So we have this fundamental fragility. The no bailout clause for governments, as I said, is not credible. We have implicit joint liability. Incentives for solid fiscal policies are undermined. They are not there, because you have this implicit guarantee. So in the next crisis, what we will inevitably get is more bailouts, more hidden bailouts through the European Central Bank, and through the ESM, and we get something very feared in Germany. We get the transfer union, but through the back door. It's not explicit because we don't like it, but we will get it anyway through the back door if we do nothing. Because these bailouts, when a crisis happens, are less costly than other ways of dealing with this, including implicit restructurings. And if we get this transfer union through the back door, we will get growing political conflicts within the union. We already have these conflicts between creditor countries and the debtor countries, and this will get worse. And in particular, if it's a large bailout, this will get a lot worse. These conflicts will get a lot worse, and I think they can have the potential to completely destroy the Eurozone if we go too far on this. That's the current situation. That happens, I think that's the situation if we do nothing. That's where we will end up. Now, what can we do to avoid that? Let me explain this reform plan we have devised. So we need to overcome the current deadlock and the current disagreement. And even if you think that you only want more market discipline or you only want more risk sharing, you won't get it, because we need to find some kind of agreement among the different countries. It doesn't make much sense to focus only on the things the Germans want, or the Dutch want, or the French want, or the Italian want. We need to come to some agreement, and I think we need to think about what could be a reasonable compromise. And in the focus of the differences is on these two things, risk sharing on the one hand and market discipline on the other hand. So the northern countries tend to say we need more market discipline. The southern countries, or the periphery countries, say we need more risk sharing. In large part of this debate, these two things are seen as substitutes. You can either go the market discipline way or go the risk sharing way. But on closer inspection, I think it's pretty clear that these are, in fact, complements. We will not have market discipline without a degree of risk sharing. If the consequences of market discipline and of debt restructuring are too harsh, it will not happen. If you want to jump, you need a safety net. Okay? And the risk sharing is the safety net, but risk sharing means there is a limited amount of solidarity. There is solidarity, but it is clearly defined and limited. This allows you to impose market discipline. So let creditors of overly indebted countries pay rather than taxpayers of other countries. That's the idea. So combine risk sharing elements with market discipline. And where we have risk sharing, we need to make sure it is compatible with meaningful incentives. It shouldn't undermine incentives. Every insurance has elements where you try to make sure incentives are preserved. If you insure your car and you want to get back everything, the entire damage, if you have an accident, you pay a very, very high premium. So that's why most people say, okay, the first 2,000–3,000 euros I will pay myself. And then in the case of a big accident, that's where I need the insurance. Okay? And the philosophy of our proposal here is, let's devise insurance mechanisms that are, as far as it gets, incentive compatible. So you only get money in the case of a big crisis. You don't need insurance for a small accident. You need insurance for the big crisis. And the first part of the damage, of the cost of the crisis, you pay yourself. Then it's much less interesting to be lax and get into a crisis, because if you pay a large part of the cost yourself, it's not so interesting. But in a big crisis, you do get some help. That's the idea. And at the same time, let's make market discipline credible. Meaning, basically, let's get the banks out of financing government debt. Or at least, let's let them be more diversified. Let them not focus on their domestic government debt. Okay, now I don't want to go through all the details, but what we offer here is a mixture of these risk-sharing mechanisms, including deposit insurance, a reform of fiscal rules, and the idea to set incentives for banks to diversify their government debt. Of course, if you say from one day to another, all banks should, Italian banks should sell their Italian government bonds, and German banks should sell their German government bonds, you have an impact on the market you may not have. So it's not so easy to do this from one day to another. So what we're saying here is the key thing is the diversification. So Italian banks should hold German bonds and Dutch bonds and French bonds, and the same for German banks. You know, they should, if they hold government bonds, they should hold a portfolio. They should be diversified. Something we also suggest is we change the fiscal rules. So if your deficit, or in our case, your spending, is higher than allowed, you can do that, nobody can stop you, but there is an agreement that the bonds you issue to go beyond those rules will be junior bonds. Okay, so we have called these bonds accountability bonds at IFO, but the idea is, you know, you can go beyond the rules, but if you go beyond the rules, you need to issue a certain type of bonds. And you cannot avoid that if there is European banking supervision, and if the ECB classifies these bonds as junior bonds. Okay, so there is market discipline on debt exceeding the allowed government debt. And then there is another element, which is the euro area safe asset, the last one here. This is an idea going back to Markus. The idea is the following: you know, we should make sure that banks are diversified. So we will change banking regulations to allow for the creation of a new type of government bond, which is something like an asset-backed security. So you have institutions buying a portfolio of all bonds in the Eurozone and financing this with a senior and a junior tranche. I will come back to this proposal in a minute. It's a bit technical, but it's important. Okay, so what you see here is this mixture of more market discipline and risk sharing. Maybe for time reason, I would just like to illustrate one element here of risk sharing, which is the idea of creating a fiscal capacity. This has been very much discussed in Meseberg and in other contexts. So the idea here is, in the Eurozone, you have the problem that if you are a member state and you get into a crisis, you lose monetary policy. You don't have your own central bank, so you lose monetary policy as a tool. And if the shock is large, you need a forceful response with fiscal policy. And countries cannot do this on their own. So you say, okay, let's have some kind of insurance for large accidents. So how does this work? First of all, to be a member of this insurance, you need to have a reasonable track record. So you need to show, generally, in normal times, you respect fiscal rules. That's the pre-qualification. What is the trigger? You can do this differently. So we have said, you know, the trigger is if there is a large increase in unemployment, for instance, 2 percentage points within a year. So the idea is you have a large crisis. You can calibrate this differently, but that's one idea, okay? So you have a large crisis, your unemployment rate increases by 2 percentage points. Then you get a one-off transfer, for instance, 0.25% of your GDP for each percentage point increase of unemployment above the trigger level. So if your unemployment rate increases by 3, you get a one-off transfer of 0.25% of GDP. So if German unemployment increased by 3 percentage points, which is a lot, Germany would get 0.25% of its GDP, 8 billion euros out of this pot, okay, in help. That's the idea. So only in the case of a large crisis and only once. And only if you, in normal times, have respected the fiscal rules. So, you know, what's discussed a lot at the moment is a permanent Eurozone budget. We don't need that. We don't, at least not for stabilization purposes. You know, it doesn't help. It may help for other things, but you know, not. So the idea is, in normal times, this thing is not active, but if there is a large crisis in one of the member states, you can activate it. Now, let's assume we had this since the beginning of the euro, this example. What would have happened? Who would have got money out of this pot? You can see here that in 2009, Estonia would have got money, Ireland, Latvia, Lithuania, and the Slovak Republic. And Spain. Spain had a severe crisis, 1.6% of their GDP they would have got. So, you know, you kind of reach the right candidates here. Then in 2010, Greece would have got money, and they would have got money every year out of this insurance system. Okay, roughly 1% of their GDP, which isn't very much, but you know, it is a form of help. Italy would have got nothing. almost nothing. In 1 year, 0.1% of GDP. France would have got nothing. Germany, of course, would have got nothing, not even in 2009. So one thing you see here, if you have this kind of thing, the small countries will benefit more than the large because their volatility in unemployment rates is higher. Something to be discussed. You can refine this and say, okay, if a country has got money out of the pot repeatedly, it has to pay higher contributions. You can add all kinds of ideas to deal with moral hazard. But the idea is, let's have a fiscal capacity that helps countries in the event of large crisis, not in the event of small crisis. You can say, some people will think, this creates moral hazard, but does it really create very much moral hazard? Do you accept having a large crisis with such an increase in unemployment just to cash in this money? I'm not sure. There's always an element of moral hazard in insurance contracts. It's unavoidable, but I would say here it's under control. Here you see the revenue and the spending in this pot. We had 8 good years in the Eurozone. Spending would have been 0, and this would have been the red line is income of this pot per year. So there would have been 8 billion or 9 billion euros flowing into this pot, 3 coming from Germany roughly. For the first 8 years, then there would have been payouts, and these payouts would have gone down to 0. So this would have been financed with relatively minor contributions. Here you see the accumulated funds in this pot. You see a little dip, but then this would be going up, and we would probably say, okay, if we have 100 billion or something in this pot, we stop. We end the contributions. So I'm showing you these very simple numbers just to give you a feeling for the amount of money at stake and for the fact that at least in the Eurozone so far this fund would have worked. It wouldn't have run out of money. Of course, if it runs out of money, you don't get anything. Okay, so this would have worked so far. Now let me come to this idea I mentioned. You could explain it much better than I can, but I'll still do it. The euro area safe assets. So this is an idea which is strongly disliked in Germany, and I will come to the reason why. The idea is, we create a euro area debt instrument backed by national bonds. There is no mutualization of risk. No mutualization of risk. So we have private actors who sell this bond. If you want to do it, if you have a bank and you want to do it, you just buy a portfolio of government bonds. Someone doesn't want me to explain this proposal here. Okay. So you buy a portfolio of European government bonds and you finance that using some junior tranche and some senior tranche. Okay, so junior tranche means part of the financing is done with paper which will lose its value if there are losses on the portfolio of this bond. Okay, so what are the consequences? For me, the main consequence is that if banks buy the senior tranche, then you have an asset in the Eurozone where banks are effectively very diversified because what's backing the senior tranche is a diversified portfolio of bonds, and it's a very safe asset because a lot has to happen before if the junior tranche is 50%, let's say, a lot has to happen before the junior tranche loses its value. And then more has to happen in this bond portfolio for the senior tranche to suffer. Okay, so it's a relatively safe asset, and in principle it's based on diversification and tranching. A lot of people don't like it because they say, look, in the financial crisis we had these asset-backed securities, and we don't want that again. I think that's misleading because we had the problem in the financial crisis was not that we had asset-backed securities. The problem was that these securities were so complicated that many people didn't understand what they were buying. This thing here is very simple. Everybody understands it. It's just the portfolio of government bonds, and you have a senior and a junior tranche. You can tranche it more, but so the issue here is not that it's not transparent. And another property which I find very important and interesting is that it actually facilitates the restructuring of government bonds. It makes market discipline stronger. Why? Assume you have banks holding this government bond, holding the senior tranche, and now one country goes bankrupt, let's say, or the debt is restructured. Let's say Portuguese debt is restructured or Greek debt is restructured. Then the senior tranche loses value, but the junior tranche loses value, but the junior tranche is a risky paper. Banks don't hold it. So you have no impact of government debt restructuring on the banks, zero. Okay, you only get that if you have a massive restructuring of many countries, but then we would have a big crisis anyway. Okay, so in principle, you would say countries like Germany should love it. It's a great proposal because it's an elegant way. It looks a bit like Eurobonds, but there's no mutualization, and you even intensify market discipline. It's a very smart approach. So Germany should love it. Why does Germany not love it? First of all, the northern countries don't like it, and the southern countries don't like it either. So the southern countries don't like it because it makes market discipline stronger, or could make market discipline stronger. We'll see in a minute that it doesn't necessarily end up doing so, but it could make market discipline stronger. So they don't like it, and that makes sense from their perspective. But the northern countries don't like it because they think the rules will not be respected. And here I'm coming back to the trust issue. So, one story I hear often is the following. If people understand this thing at all, they say, oh, it's a great idea, as long as the rules are respected. But what will happen is the following. In the first crisis, trading in the junior tranche will end. Nobody wants to buy it anymore because it's too risky. And then the European Central Bank will look at this and say, look, it's market failure. The transmission mechanism doesn't work. And it's true, if there's no trading in the junior tranche, the transmission mechanism doesn't work anymore. It's the same as the OMT program. The transmission mechanism doesn't work. We need to introduce some kind of liquidity. We will only buy 30% of the junior tranche, but something needs to happen. And if that comes about, you have Euro bonds through the back door. And that's exactly the fear of those who criticize this. And I think what's important here is that it's not that this technical construction isn't right. I think it's very smart. But there is no trust in rules being respected. And nobody will stop the ECB if it does that. Okay, you can come up with good reasons. And here at this point, I think the OMT has done a lot of damage. In the OMT program, the ECB also argued its monetary policy. It was fiscal policy, of course. It was a rescue operation for particular countries that were in difficulties. I know that's controversial, and it's probably something we can discuss later. But for me, it's a crystal clear fiscal operation. But the ECB, because it cannot officially do fiscal policy, argued in front of courts and everything. This is monetary policy. We don't worry about fiscal issues. We are only concerned about the transmission of monetary policy. That's why we guarantee the debt of these countries in difficulties. I think nobody, even within the ECB, believed this story, but it had to be told because otherwise it would have been an open violation of the mandate. And I think this has done a lot of damage because what you expect now is, of course, here you can tell the same story, and that's why instruments like that, and I guess other forms of financial engineering, just won't work. Okay, and how do we overcome this? It's not easy. And let me, close with this. Here's this key issue of limited trust in the reliability of rules, and I think that's a big impediment for reforms. And we will only overcome this if we do other things together. And I think there are. Here we have discussed a lot of European projects we can start, but they are not in the area of Eurozone. It's more about creating a common defense, having common infrastructure projects. I think we need to have more successes of that kind, because if we cooperate in all of these areas here more effectively in foreign policy, if we show in Europe that we are able to do that, I'm convinced trust will grow, and also incentives to deviate from contracts are smaller, because if you do that in one area, you get difficulties in another area. And that's why I would say we need to make progress on this front. and only then will it be possible to move more decisively in the area of Eurozone reform, which doesn't mean we should do nothing in Euro area reform. I think we need to go on discussing this issue of sovereign exposures, but progress will be limited because, you know, the disagreement in this area is so large. Okay, thank you very much.